Okay, so I think we are live. A very good morning to all of you. This is CA Gaurav Sukhija this side. First of all, I would like to say a special thank to Tax Guru for organizing this small session on M&A tax, for me helping you out and make you understand what M&A tax intricacies are. I'll be delving upon things in a very, very brief manner today. First, we'll be talking about little about how M&A tax works, what kind of things works in the M&A tax, what are the areas which are M&A tax. We talk about we'll also be talking about why M&A tax is needed and all of those. Before that, I take the opportunity to introduce myself. I am CA Gaurav Sukhija. I am partner, registered valuer at Kirtan and Pandit LLP, Chartered Accountants. I am partner, national leader with transaction advisory practice of Kirtan and Pandit. My work experience spans around 10 years now, and I've worked around in valuation, due diligence, and M&A tax. I was working with SS Kothari, did my articleship there, and then I went to Deloitte. In Deloitte, I was in the M&A division. I would have done not less than 30 M&A assignments until now, wherein I'm talking about wherein we've done the M&A and countless number of concept notes which we have given on whether it should be a merger, it should be a demerger, it should be a slump sale, or it should be an itemized sale, or other options, whichever are available, sometimes taking over of the IP and those kind of areas. Currently, I do not less than 500 value. I've not done less than 500 valuations until now, and M&A tax is one of my code field, not just mine, also of my team. So, first we'll understand what are the key objectives of M&A. What do we understand of key objectives of M&A? I would like to have the chat box also here. Uh, just give me a second. I'll just see if I can see the chat box here. Sanjay ji, can you type something so that I'll be able to see the chat box? Yeah, now I can see the chat box. Yes. So I'll be taking all your queries. I'll see how many, queries there are. If there are any queries as such, I'll be taking them over while, delving upon the topic. First are the key objectives of M&A. There are two kind of drivers. The first driver is ideally the internal drivers. Internal drivers are when we are looking to do some tax optimization, wherein, one of the company is having losses and the other company is having profits over a period of time, and we see a lot of synergies coming out of both the companies. We tend to ideally merge both of them so that the losses and the profits can get set off and we can get benefits of the same. The second would ideally be value unlocking. Why do we do mergers? Why do we do demergers? Why do we, do slump sale and all? Basically, we do this so that there is some value unlocking for our stakeholders. It's not just about the company; it's also about the shareholders. Recently we heard that Geofin got demerged from Reliance Industries, and why did that happen? Is because so that there is two separate companies having two separate administration could ideally have their own independent shareholding pattern, their own independent walkthrough over a period of time, and it could unlock value. Which, if in case, let's assume today, when we talk about Reliance Industries, there are a lot of small companies, Reliance Retail Ventures, we have Geo Telecom, which is part of the same, gamut at this moment of time. If we demerge them over a period of time, this will actually unlock a lot of value for the shareholders of Reliance as well as for the management of the Reliance, so that they will have independent run of all the companies separately. So that helps in value unlocking, and value unlocking is not just about demerger, it's also about mergers. We do a lot of mergers for value unlocking. Is why? Because there are a lot of synergy benefits. For example, there's a small company based out of South India, and there's a big company based out of North India. The North Indian company wants to acquire the South Indian company so that they have some, more presence in the South India. So now in those cases, the North India company will ideally merge the South Indian company in itself, and then will have better value. Similarly, goes for people who want to go from West India to East India, East India to West India, or you want to go internationally, so you do mergers in abroad. Those kind of things. Sometimes there are cash trapped into one company. So let's say one company is a cash cow, and India, ease of doing business is wonderful. We all know about it. So what happens is, let's say one company has a lot of cash and the other company needs a lot of cash to actually grow over a period of time. So what is the way of doing it? Is that one, we do investment into that company. Let's say a subsidiary is more cash rich than holding company, but the holding company needs cash to start doing bigger operations. So what do? We do is we merge the subsidiary into the holding company, and the cash trap and the balancing gets better. The other one is the simplification of the group structure. What do we talk about simplification of group structure is? See, I'll give you a very simple example. In the real estate organizations, a lot of time, when there is a new structure created, a new development, a new uh, project is coming up. So what they do is, one company is a land holding company. It always remains as a land holding company. The other company remains as a marketing company. And there's third company, which is the construction company, which is created. Now, they do this so that there is separate segregation of all the legal requirements which are there. So let's say there is something which the construction company did wrong. Because of that, the ownership of the land shouldn't be hampered. And let's say something bad happens with the marketing company, then the construction company should not be hampered about it. So therefore, they create three companies. Now, over a period of time, when they keep doing different projects, once the whole project is sold, then the marketing company becomes redundant. There is nothing to do in that, and they can't use that company to another company. While they can't use this company for another project, is because there must have been a lot of approvals, benefits, a lot of tax holidays they may have enjoyed, and which they don't want the baggage of the same to go to another project. So these companies become redundant. It's very common in the real estate sector. This happens a lot. So then there are a lot of shell companies which get created. It's not because the company wants to create the shell company. It's the nature of the business which creates shell company in the business. So then they just simplify the whole group structure and they merge the whole real estate together. Then for growth, for deploying capital to eliminate competition, sometimes people acquire smaller companies so that they could eliminate competition with them. And then, as I told you, if a South Indian company wants to acquire a North Indian company, or a West Indian company wants to acquire an East India company, or maybe a US company wants to acquire an Indian company, or an Indian company wants to acquire a US company to enter into new markets, it's very, very important to have the objectives of M&A. Then why M&A? It's not just about the objectives. We do M&A. That is, key objectives of M&A is why at some moment of time we think about getting an M&A. Then when we do an M&A, then in that case, M&A is mergers and acquisitions. So I'll tell you about, it's not just about mergers and demergers. It's about a lot of other things. So like funding and repatriation, sometime for pre-IPO structuring. So a lot of companies come to us nowadays. 2024 is a wonderful year of IPOs. You will see a lot of good IPOs coming in, a lot of returns, better returns, which will come out of the IPOs. And in this, pre-IPO structuring, what happens is when the company has a lot of messy group structure, wherein there are a lot of subsidiaries, there are a lot of holding companies. So what they do is they tend to merge those companies or demerge those companies or close those companies over a period of time. So for pre-IPO, then attracting overseas investment, you can't have overseas investment into a company while you have messy group structures. Ease of repatriation of funds, definitely for the fundraise. Then comes structure rationalization, as I told you, for wherein I was talking about simplification of group structure. It's similar. Overall efficiency through business consolidation, segregation of different sets of business, value unlocking to create optimum holding structure. Other reason may be exit non-core business. So sometimes what happens is you are basically into, let's say, into textile business. Yeah. And over a period of time, you also acquired a lot of real estate. There are a lot of textile companies who might not have done good in textile business, might not have done good in textile business, but they've done wonderfully in the real estate business. So what they do is they just exit the non-core business. Is that they just transfer their real estate business as such into a new company, and they keep doing the textile business into the real company. And over a period of time, maybe the textile company gets acquired and the real estate company separately works towards maybe for development of housing, for commercial, for malls or things like that. They do that in the real estate business. Then part of global restructuring, we do a lot of business wherein, internationally two companies got merged and there are few companies in India as well. So one of the example is Dorma Kaba. If you've heard of them, it's into because I'm taking this session today from home, I could see this example very easily because I'm just sitting near to a gate. So the door knobs and everything comes from Dorma. So there's another company, Kaba. They both got merged internationally. So we did that merger here in India in Dorma Kaba. Then, achieve growth, competitive position, market leader, economies of scale, diversification, growth, new technology you want to acquire, acquisition of new business. These are few of the things. Now comes what is the M&A landscape? A lot of people come to me and say, Gaurav, what do one company comes to me and says that, Gaurav, we want to simplify our group structure to the max possible, to the best possible. We want to do that. So I told them, okay, send me the group structure. I'll study it and I'll get back to you with a concept note of whether you should go, which way you should go in the M&A sector. Then the CFO or the CEO just tells me, Gaurav, why do you want to give me a concept note? What is there in M&A? It's just about amalgamation and demerger, which I tell them no. It's not just about amalgamation and demerger. There are other things also which are involved in the merger and acquisition, wherein the first and foremost is the acquisition divestments. That is business purchase sale, share purchase sale, wherein you do slump sale, itemized sale. Slump sale is generally exempt from GST. People do slump sale, but they do itemized sale also. Then comes merger and demerger. Yeah, this is the core of the M&A. Anyone who is doing M&A, anyone who is doing anything other than M&A would ideally be doing, uh, the mergers and acquisition more as compared to other areas. So then comes internal restructuring. Internal restructuring is basically, when you do capital reduction or buyback. So capital reduction and buyback are generally done wherein you want to give exit to some investor personally. So these are done at that moment of time. Amalgamation and demerger are generally the most used methods, and then comes slump sale, itemized sale, which are the second used methods. But nowadays, due to the time constraint, in the amalgamations and demerger, it takes not less than 3 months to 6 months. Sometimes it takes 2 years to do a merger or a demerger. Capital reduction takes another 3 months, 4 months. Buyback also take around 3 months, 4 months. Slump sale is like very fast. So if you want to acquire a company and you think that if you don't acquire it right now, someone else might acquire it, and you can't really spend time on mergers and demergers and capital reduction and buyback, you generally go for slump sale as such, and you go for the slump sale and itemized sale instead of going off all of these. So, but we'll not be touching much upon slump sale and this. We are touching today basically over the M&A and the mergers and the demergers. So there are a lot of tax and regulatory aspect. It's not just about it is not just about the Income Tax Act or the Companies Act. It's about the whole spectrum of tax and regulatory aspects which are there in India. In India, the beautiful thing is each area of business is governed by a different organization altogether. So, for example, when you are a listed company, it will be taken care by SEBI. If you are an unlisted company, the listed company will also be taken by Companies Act, but unlisted company, there are major other information and things which Companies Act would be taking care of. Then comes FEMA if you are an international company or you're an MNC or you're acquiring someone outside. If there is an inbound investment or an outbound investment or a cross-border M&A, or you're doing simply a share swap with some company, then FEMA will be attracted. Then comes tax. Tax is there everywhere in India, whether it is GST, whether it is income tax, whether it is tax neutrality. There is tax neutrality in various aspects. Tax neutrality is what? That when there is no tax which you need to pay, there is no value which is being created in the eye of the tax man. In that case, you don't need to, then it is known as tax neutrality. Then comes stamp duty, because every state earns from stamp duty, so a lot of stamp duty is applicable on various kind of areas. Then comes valuation, competition act, NBFC, sectoral regulator. In the competition act, if you've heard, recently there was one merger which was happening, wherein the competition act was having a lot of problem. If I could see people on the chat, I would like to know if you know any example per se, which, because in which case the Competition Act was there. There was a merger which was happening very in the very recent past, and people, the Competition Act was there in the news a lot. Can someone give me an example of that? I'll be waiting for you over the chat. Yes. So, yes, Z and Sony was one of them, wherein, recently, which actually got cancelled. Z cancelled or Sony cancelled or who cancelled, we really don't know. Though Z is trying to put a case over Sony, that they said no, and Sony is saying that there were a lot of regulatory gaps wherein they couldn't do work. So Sony is asking for the same. So that's where it is. So now talking about M&A tax landscape, wherein I'm talking about just mergers and amalgamation, demerger, and all of those. These are, you can take a screenshot of this specifically, which talks about only Income Tax Act and the M&A tax landscape. That is, which section is specifically applicable. We've tried to summarize it to max possible. We've put all the best sections which are there, which are directly relatable to slump sale, to buyback of share, for reduction of capital, for takeover of shares, for demerger, for amalgamation, and all of those. We'll be delving in more detail about M&A tax and also, mergers. First, let's talk about merger. How many type of mergers have you seen? There are horizontal mergers. Horizontal mergers are when you are into one business and you are actually doing merger in the similar horizontal area. That is like, for example, Vodafone and Idea. Vodafone and Idea merged together to become VI, and this is known as horizontal merger. Then comes vertical merger. Vertical merger is, let's say, you are into sugar industry and you are going into power sector, or you are going into ethanol production. So that is known as vertical movement. You acquire a company which is already doing ethanol, you're already doing sugar, so your sugar company acquires an ethanol company. That's known as a vertical merger or a vertical demerger kind of a thing. We've given an example of Uptron Color with BPL. Then there are conglomerate mergers. You heard of ITC. ITC, the full form is Indian Tobacco Corporation. So it's actually talks about the cigarettes and the tobacco and all those areas. But ITC has a wonderful area in the line of hotels. So they acquire a lot of hotels. That's known as conglomerate mergers. And then comes reverse merger. Reverse merger is wherein a loss-making entity acquires a profit-making entity. There are various reasons for that also, which we will discuss in detail if you come to me personally. But a lot of unlisted companies acquire a listed company to become listed directly. So those kind of things also happen. So KB Mall with Future Network was one of the example. So first we talk about merger as such. What is the definition of merger? For the purpose of tax neutrality, Section 21B of the Income Tax Act says that all the assets and liabilities of the transferee company needs to get transferred, of the transferor company needs to get transferred to the transferee company. All the assets and liabilities need to be transferred. It cannot be that you talk about sometime what people comes to me and says, Gaurav, I want to do a merger, but I don't want to transfer my real estate. Can I do a merger? I say you can do a merger. There is no problem in that case. You can go to NCLT, get the approval. You can go to RDROC if you're doing a fast track merger. But please make it a note, it wouldn't be a tax neutral merger. It will attract capital gains in that case. Whatever value you do to the company, whatever swap ratio you do, in that case, it will attract taxation, if any. But in case you just do all assets and liability, then it will be tax neutral. Then comes next is shareholders. There should be at least three-fourths of the old shareholders who should become the shareholder of the new company. So the transferor company shareholders should get the shares of the transferee company. So shares are issued to at least three-fourths of the old shareholders. If this happens, that all assets and liabilities are transferred and at least three-fourths of the shareholders become the shareholder of the transferor company, then it is a tax neutral merger altogether. So you don't have to worry about that. Merger as a result of acquisition of property by one company shall not tantamount to merger. As I was giving you this example, that is, if you just do one property, you're saying that I'm not getting acquired, I'm just transferring one property of mine, let's say an office building, I'm just transferring that. That doesn't tantamount to merger under Section 21B, so it won't be a tax neutral merger. Now, a lot of people tell me, Gaurav, if assets and liabilities are not being transferred, all assets and liabilities are not being transferred, then how can you call it a merger? See, the merger is actually defined under Companies Act. The combination happens under the Companies Act. You are merging two companies as such. Income Tax Act only gives you a holiday or a benefit. That is saying that if you do this, then the company wouldn't have any tax implication in this transaction. So, to avoid tax or to have a tax neutral transaction, you may follow 21B. If you don't want to follow 21B, still the merger will happen. Merger as a result of distribution of property of one company to other company after the binding up of the first mentioned company shall not enter bound to merger. So a lot of people come to me and say that, Gaurav, my company is getting liquidated and we are transferring all the assets to another company. Will that tantamount to merger? No, that will not. The one company should need to get a share. Three-fourths of the shareholders should get the shareholding in the company. Uh, Definition is only applicable in case of mergers of companies. The share allotted to transfer company is not subject to any lock-in. So it's not like if the company's shares are coming to a transfer company, it is not, there is no lock-in as such, which is there. Uh, yeah. So now taxation and amalgamation key aspects. There is no capital gain implication as such. It is a tax neutral transaction. There is no capital gain implication as such. Depreciation shifts to the amalgamate, tax neutrality for shareholder, even for the shareholder. You know, Now we say that we are sitting on a merger as such. So one company get merged into another company. Let's say this is a bigger company and this is a smaller company which is getting merged into. Now, these shareholders will get share of this company. Now, people say that because these shareholders have got a new share of this company, then are we talking about any change in the hands of the taxes because the shares have changed their form as such? So, because of the change in the form of the shares, there is no capital gain as such, which is there. It is exempt under Section 47(6). Carry forward of losses and accumulated depreciation. This is very, very important. We'll talk about it further in detail. And all of these taxation aspects we'll be talking about. So tax neutrality in case of amalgamation, it says transferee should be an Indian company. That is, the company in which the company is getting merged should be an Indian company. Then only tax neutrality happens. If it is a foreign company, tax neutrality does not happen in that case. Then that is the first and foremost thing. That is the capital gain won't be applicable. Second is in the hands of shareholders. So section 47(7), not regarded as transfer. It says that the holding of the shares will also be, it doesn't say here, but it says in another section. But I'll tell you, if the person was holding shares for last 3 years in the amalgamated company, that is the transferor company, then his period of holding shall also be considered same as such. So if someone had purchased the share in 2017, let's say 2017, and the merger happened in 2024, the person's holding shall be considered as on 2017, shall not be considered as on 2024. So you won't say that there will be short-term capital gain now. There will still be long-term capital gain, and there will be no capital gain as such while the share changes the form. So that is very important. Carry forward of losses and unabsorbed depreciation. This is very, very important. What kind of losses gets transferred? Accumulated business loss and unabsorbed depreciation gets transferred. But there are specific conditions for this. This is very beautiful as an example, and I'll tell you why. Legal insights on Sony and Z, that we'll tell you separately. But I'll tell you this. This is a very beautiful thing: carry forward losses and unabsorbed depreciation. So what happened in this case is, let's say the transferee company has been in losses for last 7 years, okay, and there is just 1 year left, which of the carry forward is available, or 6 years, and there is just 1 year or 2 years left for the carry forward of the losses. So what happens is, let's assume the company is getting merged in 2024, and the 6 years of the losses have already lapsed by then. It does not matter. Income Tax Act will start the losses, the counting of the carry forward of the losses from the year of merger from there. And you know why this happened is, this happened because they wanted sick companies to be acquired. And one very important thing in the current scenario is, only and only, so there are a lot of companies that come to me and say that we have two service companies, yeah, and one of the service company is a loss making entity, and the company which is acquiring is a profit making entity. Do I get the benefit of carry forward of losses and unabsorbed depreciation? No, you do not get it. Section 79 stops you from doing that. Only few companies who are in manufacturing or process of goods, manufacturing of computer software, business of generation or distribution of power, when the telecommunication, cellular network of trunking, broad-based, ideally telecom business, mining, construction of ship, aircraft, or rail system. Only these companies gets the benefit of carry forward of losses and unabsorbed depreciation. They do not get, any company other than these do not get the benefit of it. We have been lobbying to the industry that, for the purpose of the service sector to grow, for the purpose of service sector to have these benefits, these benefits should be transferred to service sector as well. But we're just waiting for that to happen. Let's pray and see that once the next budget comes in 2024, after whosoever wins the election, they bring in this as a reform. So this is very, very important reform which is needed currently in our current structure. So we'll be waiting for the same. So what do we need to do to get this? It's a very important benefit which the government is actually transferring to you, but it needs something in back. So conditions for the transferor: the amalgamation of company owning industrial undertaking, that you've already told. It should be in business for 3 or more years. If it is having losses from some business, it should be there for 3 or more years. And at least 75% of the book value of the fixed asset held continuously for 2 years prior to the date of amalgamation should be there. So they should have at least 75% of the book value of the fixed assets in the company itself. So it shouldn't be like that the company has actually transferred all the assets already to another company. It shouldn't be like that. It should be, very simply said, it should be 75% of book value of the fixed asset should be there with the company. The second is company engaged in business for 3 or more years. So the company should be engaged in business for 3 or more years. It cannot be less than 3 years. And it should be an industrial undertaking. I've already given you these examples wherein only these companies will get the benefit of transfer, others will not. But once you merge it, it does not like you get the benefits. Conditions for transfer is, it continue to hold at least 75% of the book value of fixed asset for a minimum of 5 years. It cannot hive off. So a lot of companies say that, I'm acquiring a sick company. Why do I hold its assets? I don't want to hold its assets. I just wanted their losses. So it's not like that. You can't just acquire losses of a company. You need to hold that business with you. You should have some value out of it. So 75% of book value of the fixed asset should be there. They need to continue the business for minimum period of 5 years. If they don't do that, that will be a problem. Achieve at least 50% of installed capacity before end of 5 year and continue to maintain the same till year 5. So they need to have 50% of the installed capacity should be achieved before end of 4 years, and then it continue to maintain the same till year 5. That should be there. So this is what it talks about in case of carry forward of losses and unabsorbed depreciation. Condition for set off under Rule 9C, transferee company. Then there is a Rule 9C specifically, wherein there is a certificate which needs to be given, which says that the transferee company has more than 50% installed capacity, and the transferee shall furnish to assessing officer a certificate in the form number 762 duly verified by an accountant, so establish that production levels have been achieved. So this needs to be done. at the end of the year. So this is very, very important. Points to note specifically is transfer will be allowed to carry forward a fresh period of 8 years, where such conditions are met. So I told you, new 8 years starts for the carry forward and losses. If the condition mentioned in the previous slide are not fulfilled, then set off of loss made in any previous year in the hand of transferee company shall be deemed to be the income of the transferee company chargeable to tax. That is, in which year, for the year in which such conditions are not complied with. So, if let's say in 2024 the merger happened, in 2027 they hive off the business as such, then the losses will happen. Undertaking engage means, so Satinder has a question. Undertaking should have income from these business, or it's sufficient should registered with objective to carry off such business. No, 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 no. It should be an undertaking. It should have got the business for last 3 years. Business is very, very important. How do you define a business? Defining a business is basically, wherein there are revenues, there are expenses, there are business as such that is required in the case of undertaking. So, or it's just registered with the objective to carry off side of business is not important. It should have the undertaking as such. It should have the real work. You're going to NCLT to get the approval. So NCLT will look into everything. RDROC, they will look into all entry cases specifically while giving you the merger benefits. So you just can't say that, my MOA says that I am into undertaking, but I am actually doing services. Can I do a merger? No, you cannot do a merger. You need to have that as a business specifically. So accumulated losses means loss of the transfer company and net profit and gains, not being a loss due to speculative business. Accumulated losses brought forward under the head house property or capital gain will get lost. Neither company will avail benefit to carry forward benefit. So a lot of people ask me that, there are losses from capital gain. Will I get benefit of that? Can I get acquisition? No, you do not get that. It is only and only for accumulated loss, which is there. But yes, unabsorbed depreciation you will get. It can be carried forward for indefinitely because there's no time frame for it. But business losses you can definitely do that. So before you do the merger, please take care of the capital gain losses, the house property losses, which you will not get the benefit of. You will get only benefits of the business losses which are there in the company. Yeah. Then apportionment of depreciation. It's very simple. Whatever depreciation is left for all the company, that will be a portion between transferor and the transferee company in the ratio number of days of which the assets were used by them in the year currently. Because let's say in 2024 we are sitting in the month of Feb and we do the merger in the month of Feb or 31 Jan specifically. So for 2 months, it will go to transferee company, and for 10 months, it will go to transferor company as such. If there is any amalgamation expense, that amalgamation expense that is charges paid to us ideally and to the lawyers and sometime for the government fees, whatever the specific government fees has been applicable, they will get deduction of it. 1/5 of such expenditure shall be applicable for each of 5 successive years, beginning in the previous year in which amalgamation was done, shall be given to the transferee. That is, now transfer is already gone. So what is the benefit we give to the transferor company? The benefit should go to transferee company. So I generally say that all the expenses should be done by the transferee company, not by the transferor company. Treatment of bad debt, if any debt, whether debts to the transferor transferred to the transferee becomes bad, such bad debts will be allowed as a deduction to the transferee. So there was a problem which was there. There was a case law which was CIT versus T. Veerbhadra Rao, K. Koteshwar Rao and company, wherein there were some bad debts which the income tax officer said that you cannot take benefit of the same. If there are bad debts were for the transferor company. You can't take benefit of those bad debts now. So the case law got structured, and it says that such bad debts will be allowed to be deducted by the transfer, and it is actually prudent. If we have acquired the whole business and there are bad debts, we should get the benefit of the same. Other aspects are the holding of the shareholder, as I told you already. The cost of acquisition of said asset to the amalgamated company shall be the cost for which the amalgamating company acquired it. So any asset which is there between the amalgamated and the amalgamating company, the cost of acquisition will remain the same. Same as for the shareholder. So in 2017, let's say the shareholder had acquired the share at 14 rupees per share, let's say 10 rupees per share, and now the transferee company's share is at 100 rupees. So the cost of acquisition will remain 14. It wouldn't change after the same. If the capital is required by amalgamating company before 1st April 2001, then cost of acquisition may be taken as cost or FMB or as on 1st April, whichever is higher. So in 2001, before 2001, there is a section 55 subsection 2 which says about the same. So that is there. So 242A, 49.1, 49.2, few of the areas specifically on the merger. I am open for questions on taxation relating to merger, if any. I can take that. I'll just remind it again. For the benefit of tax neutrality, you need to set all assets and liability. The shares should be three-fourth of the old shareholder should be transferred. If you do just one property, it wouldn't happen. There is no lock-in that happens. On the first section 47, the transferee should be an Indian company. If the transferee is an Indian company, the whole transfer is tax exempt. Again, in the hand of shareholder, it is tax exempt. Carry forward of losses are only available to these companies. Then coming to the condition for transfer, as I told you, it should be 3 years, 75 of the business should be there. They need to hold 75% of the business transferee. 5 years should be there and achieve at least 50% of the installed capacity. That should be there. Ideally, then carry forward of losses, you need to under Rule 9C, you need to take the certificate for form number 62. Then carry forward of losses and unabsorbed depreciation. I already told you what benefits one can get, but there is no accumulated loss under the head house property or capital gain which you get. A portion of depreciation, I told you 2 months and 10 months, that happens like that. Amalgamation expense, I told you will get benefit for one-fifth of the such expenditure for each of the 5 successive years. And treatment of bad debt also, I told you such bad debt will be allowed as reduction in the transfer. So this is all about basically about the mergers as a landscape. Now we have approximately 20 minutes in hand. We'll try to wrap up most of the part of the demerger tax landscape as well. Now, demerger is a very, very important thing to understand. What the beauty of the demerger is, the whole demerger tax neutrality or the tax related thing is in the definition of demerger as such. So if you remember, under the companies under the Income Tax Act, under the merger, there was just 21B of the Income Tax Act. Then there was Section 72, Section 42, Section 242, and all of those. There were a lot of sections which we had to go through. But in case of demerger, there is 219AA which talks about most of the areas, most of the things. So first of all, demerger. So understand that demerger can only happen of a company which is an undertaking. You can only transfer an undertaking which is having a going concern as such. You can't just demerge a company which has nothing to do in itself. It has, let's say, you talk about a demerger wherein you are demerging a non-operating company, or a lot of companies come to me and say that we want to demerge our real estate. You just can't demerge a real estate directly. You need to have business in that real estate. You need to have some employees. You need to have some income. You need to have some expenses while you do demerger of an undertaking. So all properties of the undertaking being transferred is transferred to the resulting company. There are two companies. One is the demerged company, from which the resultant company, the undertaking is getting demerged. So this is the main company, and then let's say this finger is getting demerged and going into this hand. So it's going, this hand is ideally known as resulting company. This hand is ideally known as demerged company. And this thumb, which is getting demerged, is ideally known as the undertaking, which is getting demerged. So all properties of the undertaking being transferred is transferred to the resulting company. That's one. All properties and liabilities of the undertaking are transferred at book value. This is very important. To have tax neutrality, it should transfer at book value. You cannot revalue those things. All liabilities relatable to the undertaking is transferred to the resulting company. Liability is very, very important in this case. All properties and liability are transferred at book value, but all liabilities which are directly relatable. So, for example, there is one company which is having direct liability of a short-term debt, which is directly available to them. Now, there are other debt also which are there in the company, and let's say the whole company was at rupees 100, and the undertaking's value is just 30 rupees out of it. So let's say the net worth of the total organization is 100, and the undertaking is just 30 rupees. So all the liabilities which are common and not directly relatable to any of the business, the 70 and the 30. So the 100 rupees was the company value, 70 is remaining as a demerged company, 30 is going out as a undertaking. So in that case, the 30 and the 70, so all the common liabilities shall be divided amongst them like this. So then shareholders, as was there in the merger case, shareholders more than three-fourths the demerged company becomes shareholder of the resulting company. Resulting company issues shares to the shareholder of the demerged company. Transfer of undertaking is on going concern basis. That is, you will do business in that undertaking. You just can't say that I'm transferring the business, but I'm not. It is not a going concern kind of an undertaking. So that cannot happen. So a lot of companies come to me and say, Gaurav, while we do demerger, sometimes you need to do valuation in demerger, sometimes you don't need to do valuation in demerger. In the case of merger, valuation is still needed. How do you do valuation in case of merger is swap ratio calculation. In case of demerger, when you do valuation, general cases, there is share entitlement ratio which happens. So share entitlement ratio is that it says that share there will be 1:1 mirror shareholding that will happen between the demerged entity and the resulting company as such. Generally, in the case of demerger, the resulting company is a wholly owned subsidiary of the demerged company. This is how the structure is created. So the resulting companies are generally the wholly owned subsidiary of the demerged company. Now, the demerged company, when it transfers the undertaking to the resulting company shares get transferred under the scheme, gets cancelled under the scheme, and all the shares of the resulting company becomes the shares of the shareholders of the demerged company. This is the general modus operandi in the case of demerger. There are a lot of cases, like for example, in case of Pantaloon, there was a Pantaloon demerger wherein the lifestyle business was actually transferred to the Pantaloon business. So that happened, and then basis that the whole demerger actually happened. So this is how the demergers happen in the modus operandi. General modus operandi is the resulting company is generally the wholly owned subsidiary of the demerged company. Number one. Number two, action number two is generally that the undertaking gets transferred to the resulting company. Now, the shares which are there in the resulting company, which are actually owned by the demerged company, because the resulting company was the wholly owned subsidiary of the demerged company, the resulting company shares get cancelled. And because the undertaking is coming to the resulting company, the shareholders of the demerged company gets all the shares in the resulting company also. So this is how the demerger is created. The definition is only applicable in case of demerger of companies. Revaluation, if any of the properties and liability being transferred, shall be ignored. Shares to be allotted to shareholder of the company must be on proportional basis. It cannot be on the basis of, you can't do preferential allotment or you can't do preferential issuance of shares. It should be on the basis of proportional basis. With respect to shareholding conditions, shares already held by resulting company or its nominee in the demerged company shall not be included. Shares allotted to shareholder of demerged company is not subject to any lock-in, as I've already told you. Our share swap agreement, either pursuant to the scheme or otherwise, is a common transaction. This happens. It is not mandatory that shareholders of demerged company constitute the same percentage of holding in the resulting company. Generally, it happens like that. It might not happen in few cases. Yeah. Non-compliance of 219 AA, as I told you already, of the same does not in any manner result in arrangement not being regarded as demerger under the Companies Act. It may be a non-tax neutral demerger. So if you do not follow 219 AA, it doesn't matter. If you do not follow 219 AA, still it will be a demerger, but it might not be a tax neutral demerger. This is what happens. Now, I was talking about undertaking. I told you that in case of demerger, the most important thing comes as the undertaking. Undertaking includes any parts of the undertaking, a unit or division of an undertaking, or a business activity taken as a whole, but does not include. So I've got a query. LLPs are also not included. No, they're not included. Uh, so any part of an undertaking or a unit of division or an undertaking or a business activity taken as a whole, but does not include individual assets or liability or any combination thereof, not constituting a business activity. So if, as I told you, a real estate, just they are transferring a land from one company to another, that wouldn't talk about specifically that, it is just an undertaking. It's not an undertaking. If you are just transferring a land, if you are just transferring a machinery, let's say you are just wanting to transfer a plant and machinery, and you're not wanting to transfer the directly relatable liabilities, the employees. So to run the business, it is not possible. You can't really do it. Cherry picking of assets and liabilities are not allowed. So Honorable Delhi High Court, while judgment in Indorama Textile Limited, held that in a demerger, transfer of all common assets and or liabilities related to undertaking being demerger is not required. So it also said all transfer of all common assets is not required and or all relatable are not required in case the assets and liabilities are capable of doing a business. That is what is required. That is what is required at all. So you don't just need all the assets and liabilities should be transferred. There is a case law specifically which says that in case you don't do that, you just do a simple transfer of business and liabilities which are capable of doing a business, then that is important. Delhi High Court also held that the court can examine whether essential and integral assets like plant machinery, manpower, without which it would not be able to run as an asset independent unit, have been transferred to the resulting company or not. So the resulting company should be able to perform on its own, should be able to do business on its own. If it is not able to do business on its own, then it won't happen. Yeah. Meaning of liability, it shall include the liability which arise out of the activity operation directly identifiable to non-undertaking. I told you, let's assume I'm transferring. So there is a company which is into textile as well as uh, into mobile manufacturing. Okay. So any liability which is taken to set up the mobile manufacturing unit, and let's say they are actually transferring the mobile manufacturing unit, then the mobile manufacturing units directly relatable liabilities should actually be transferred alongside this. Now there is a law, there is a case law which says even if you don't transfer it and the company is able to perform on its own, you can ideally perform it. There's no problem. The specific loan or liability with respect to undertaking other than above, general liability and borrowing in the same proportion to the assets being transferred. I told you 30/70 is the example. So the 70 and 30 can get transferred in the same proportion. That is how the liabilities need to be transferred. Demerger tax landscape. So we'll now be talking about sections, specific section under the Income Tax Act, which talks about all of those. So first of all, it is a tax neutral transaction. So anything which is being transferred in the demerger from the demerged company to the resulting company is actually a tax neutral transaction. We don't need to worry about it. So even if it happens, now it's just that the resulting company should be an Indian company. That's very important. So that is very important. That is the resulting company should ideally be an Indian company. This is important. If this does not happen, then there is a problem as such. Yeah. Next comes is the tax neutrality in the hands of the shareholder. So as I told you, shareholders will get new shares, but it is not taxable in the hands of them as of now. It will be taxable when they will sell it. It is not taxable right now. So any transfer or issue by RC to the shareholder of the DC, if the transferor, resulting company and the demerged company, if the transfer or the issue is made in consideration of demerger, in case of demerger, existing shareholders of DC will hold shares in the resulting company and shares in the demerged company. Cost of acquisition will compute it as under. So this is very interesting. By virtue of section 49 2D of the cost of acquisition of shares in the demerged company shall be cost of acquisition of original share in the demerged company. So if you purchase the shares for 20 rupees, yeah, less cost of acquisition of shares in the resulting company as calculated in section 49 2C. Cost of acquisition of share held in same proportion as net book value divided by net worth of the DC. So if on the basis of the net worth which is being transferred, on that basis, if the company is 100 and let's assume you purchase the share for 100 rupees only, okay, the company's net worth was 100, you have transferred 30 rupees here and 70 is here. So the cost of acquisition 30 will go here, 70 will go there. Generally, the company also tells you the cost of acquisition benefit, the percentage transfer. In the scheme, it is written specifically. Carry forward of losses and unabsorbed depreciation, section 72A4. Losses and unabsorbed depreciation of the demerged company shall be carried forward. Where such loss or unabsorbed depreciation is directly relatable to the undertaking transferred to the resulting company for the remaining period only. It is not that you will get it for more 8 years as you are getting in the merger You won't get it in the demerger. So in the case of demerger, it is for the remaining period only. Be allowed to carry forward and set off in the hands of the resulting company. Where such loss or unabsorbed depreciation is not directly relatable to undertaking transferred to the resulting company, be a portion between demerged company and the resulting company in the same proportion in which the assets of the undertaking have been retained by the demerged company and transferred company, and be allowed to be carried forward as the case may be, set off in the hands of demerged or the resulting company as the case may be, but for the remaining period only. So carry forward of losses that was happening there in the case of merger was happening that from that year another 8 years were starting. In the case of demerger, that does not happen. So in the case of demerger, the thing remains the same. See, merger as such was giving these benefits because you were acquiring a SIC unit. Yeah, demerger is not to acquire a SIC unit. It is not to give benefit to any third party. Government will give you benefit if you give benefit to its public as such. In the case of merger, you were giving benefit to the public. Is for example, there's a sick unit. The the factory workers may lose job over a period of time. A good company, let's say Reliance or Tata or Ambani's or Adani's or whosoever big Birlas are actually acquiring that company. That actually giving a respite to the the workers who are working there, to the raw material supplier, to the wholesalers, retailers of those companies. You're giving a respite to them. Hence, there is a benefit of Section 72 there, wherein it says आपको 8 साल के लिए और losses मिलेंगे. यहाँ पे वो benefit, here that benefit is not applicable. So you won't get that benefit here as such. Now, apportionment of depreciation. For apportionment of depreciation between demerged company and resulting company, following steps should be followed. Assume that there has been no amalgamation and compute depreciation for the demerged company. Specifically, you compute depreciation. Once computed, depreciation amount shall be apportioned between demerged company and resulting company in the ratio of number of days for which the assets were used by them. As I told you, if let's say we are doing in the month of February, in the month of 31 Jan, 10 months will go into that, 2 months will go into this. So this is how apportionment depreciation will happen. Again, amortization of demerger expenses shall be given to the resulting company, 1/5. So I generally say the expenses should be done by the resulting company itself. It should not be done by the demerged company because the demerged company don't get the benefit of it. And if any proportion of such expenses is considered by the demerged company, resulting company shall amortize the remaining portion only. So generally, it shall be given to the resulting company. So resulting company should do all the expenses. Where the debt of the demerged company transferred to the resulting company becomes bad, such bad debt will be allowed as a deduction to the resulting company. Same case law we are referring here. By virtue of section 225, 222V, section 2, clause 22V, there will be no, V idly 5, there will be no dividend in the hands of shareholders on distribution of share pursuant to demerger by resulting company to the shareholder, to the demerged company. So people were saying that, now a person, why you're doing a demerger, what you're doing is you're giving more shares to the shareholders. Yeah. This could ideally be talked as deemed dividend because shareholders are getting some value out of the company. So it's not like that. There is no value which the company is giving. It is a tax neutral transaction. So hence there won't be. By virtue of amendment in section 242A, for calculating the period for which the shares are received upon demerger are held, period for which shares were held in the demerged company shall also be considered. So if you were purchased shares in 2017 in the demerged company, the company got demerged in 2024, the holding will remain the same. Can you please explain how the ratio of shares to be allotted to shareholder of DC in the RC works out to be tax neutral? Yeah. So it's very interesting. It's very interesting. In case of so the question is, how does the share transfer? Can you please explain how the ratio of shares to be allotted to shareholder of DC in the RC works out to be tax neutral? Is that generally in case of demerger, there is share entitlement ratio which happens. So Shishir, what happens is the resulting company, if it is a wholly owned subsidiary of the demerged company, the shares held by the demerged company in the resulting company gets cancelled by the virtue of the scheme. That is the first thing which happens. Second thing which happens is all the shareholders of the demerged company gets the share in the resulting company in the same proportion. This is how generally it happens. But if in case this company already has some business and The demerged entity, that is the thumb, which I was always referring to, the undertaking, if this is getting transferred to the resulting company, there will be share swap calculation. That is the value which this company has per share and the value this company has per share, that will get transferred over a period of time. So that is how the calculation is done. This is a tax neutral, is why? Because there is no money which has come into the hands of shareholders. How will they pay taxes out of it? So understand the thing that the shareholders are only getting shares of the resulting company. If the undertaking is getting transferred, the shareholders here, the demerged company shareholders are only getting shares in this company. They're not getting any money out of it. How will they pay taxes in that case? So hence it is a tax neutral transaction as such. It is by the virtue of the Income Tax Act, which says Section 47, that is a tax neutral transaction. So hence it is a tax neutral transaction. And anyways, the person has not received money. So if the person has not received money, they don't have the cash outflow to pay taxes to the government as such. Resulting company must record the cost of asset transfer pursuant to demerger as equal to the cost that would have been recorded in the books of demerger. That is the actual cost. There is exception in the case of India, that may be there. Uh, we are going to cover only merger and demerger in the today's session. We're already at the end of the session because just 3 minutes are left. Slump sale, I had few areas. Buyback, I had few areas. Reduction of capital, a succession of sole proprietorship by the company. All of those was there, but we're not touching upon those areas. We'll delve into those areas once we have a bigger section session with Tax Guru. Now because we are already at the end of the session, I would again like to thank Tax Guru for organizing this wonderful session. I am really thankful to all the audience who came in on Sunday, took out time, to understand new things, to learn new things. I love doing this on regular basis. I have done this with Taxman. I've done this with, NIRC, with ICAI, with ICSI, at various FICCI, CII. I keep doing these sessions, and I love talking to new people. Because I'm a national leader, transaction advisory at Kirtan and Pandit, it's my responsibility to talk to new people, to understand how the industry is going, to be a thought leader in this area. You have my contact details here. If anyone wants to connect with me personally, you can do that. I am on LinkedIn as well under CA Gaurav Sukhija. You can search Gaurav Sukhija, Kirtan and Pandit. You will get me. There are very few people who are under Sukhija. And this, I would like to conclude this. I have Mr. Sanjay here from Tax Guru. Would seek would seek how do I close this session, because this is my first session with Tax Guru. Should I just stop sharing? Should I just close the session? What should I do? I'm open for all the questions, if any. These are our offices and our contact details for the office, if you want to connect. Our organization, Kirtan and Pandit LLP Chartered Accountants, is a 30 partner, 800 employees CA firm having offices at 7 locations, that is Pune, Mumbai, Delhi, Bangalore, Nasik, Hyderabad, Chennai. I am currently sitting at the Delhi office, but I head transaction advisory across the nation. So my team sits in Mumbai, Bangalore, Nasik, Pune, Hyderabad, Chennai, and everywhere. We are available on our website, on LinkedIn, Facebook, Instagram. Do follow us. We do a lot of good insights on various areas on regular basis. So I would like to thank you, all of you, for being here. Would love to have a recording of the same session with me. So thanks to Tax Guru for organizing this, and thanks to all the members once again. Thank you very much. I take the exit here. Mergers and demergers was the major area we were discussing today. I believe I was able to add some insight. I was able to give you some insights of the same. Thank you very much. Thank you. Sanjay ji, would you like to add something, or can I just end the session?
Thank you very much, sir. Thank you.